Welcome to the Illinois Farm Economics Summit. This is the 2021 version. Thank you for being with us today. We're glad you're here. If you're here, don't worry about the rest of them. You'll be already signed up for everything, and well, you'll get an email from us for the rest of these summits. If you're watching this after the fact, please visit farmdocdaily.illinois.edu. Get yourself signed up for the summits. They run this week and next week in the early part of December of 2021. We're going to kick things off with a market outlook as usual. Talk a little bit about corn and soybeans. Scott Irwin and Joe Jansen are here, both agricultural economists and the College of ACES, Agricultural Consumer and Economic Sciences. Thank you so much to the two of you for being with us. Joe Jansen, good morning to you. Thanks for being here. I think you're going to kick us off for the day.
You bet. Thank you very much for the introduction, Todd. So we're going to go through and talk about the current market situation for corn and soybeans. We'll spend a little bit of time thinking about what the rest of this current marketing year, the 21-22 marketing year, looks like, and then move into what we think, where we think things might go for the 2022 crop and beyond. We'll start by just a brief look back at how we've gotten to the point that we are today. This shows the history of the March 2022 corn futures price through 2020, where we saw prices down below $4. In the middle of 2020, a slow and steady climb early in 2021. And reaching a peak in about May. So we've seen kind of a much more volatile, but also higher price situation since the middle of this year. Right now we stand at about 585 when I checked the markets this morning. So probably right about the level where we're at. And so the question is, with relatively high prices, kind of where do we go from here? For soybeans, the picture looks semi-similar. We had very low or relatively low prices more than a year and a half ago, with soybean prices for March 2022 delivery down below $9. A long and steady climb through 2020 and 2021, again peaking in the middle of the 2021 growing season. And then for soybeans, we've seen maybe drifting lower. Some relatively recent strength. We stand now at 1265 when I checked this morning for March 2022 soybean futures price. So given where we've come from, we want to sort of look at the situation for this old crop, the 2021-2022 marketing year. The crop size is largely in the books. We'll talk about what the current balance sheet looks like in a second, but the big outstanding item is use and demand, and so we want to look at what the global market picture for corn and soybeans looks like. This is the USDA's most recent numbers for both the corn and soybean world balance sheets. All of these numbers are in millions of metric tons. So we basically the big picture story here, looking at both sort of the usage numbers here, with the column labeled domestic total, and then the ending stocks numbers representing sort of how much we think we're going to carry out of this marketing year into the next one. The big picture story here is a rebounding global supply for both corn and soybeans relative to the 2020 crop, which was smaller in many places, including the U.S.'s major competitor for both of these crops, that is in South America, especially Brazil. So we're seeing slight rebound in availability. The global stocks to use ratios increasing slightly. In part, that's rebounding supply, but usage is strong, and so the tightness of the global market for both corn and soybeans is still sort of relatively tight compared to where we were maybe a year and a half, 2 years ago, when we saw much lower prices. Going forward for the rest of this marketing year, for the United States, export competition is an important kind of outstanding factor. So the major players here are obviously the United States and South America. That's Argentina and Brazil. And then on the corn side, Ukraine is a major export competitor as well. Exports from all of those competitor nations, Argentina, Brazil, and Ukraine, are expected to be relatively strong, both for corn and for soybeans. So we want to take a look and think about, okay, given sort of who's on the demand side, where is that demand coming from? A lot of that is from China. China is the biggest importer on both the corn balance sheet and the soybean one, but the corn balance sheet being a little bit more diffuse. How likely is it that we're to get to the export number that USDA projects for the United States? 63.5 million metric tons for corn, 55.8 million metric tons for soybeans. So we're going to look at the export sales pace. That blue line at the top represents the current WASDE forecast for corn. That's 63.5 million metric tons. The orange line represents committed sales and actual exports from both starting on this graph, both before the start of the marketing year, which begins on September 1st. So on the corn side, we saw really strong export sales commitments made earlier before this crop came off. We see a big jump in that orange line in early May. That's China coming into the corn market and committing to buy significant amounts of U.S. corn. Within the course of about 3 weeks, they committed to buy about just under 11 million metric tons. We see that pace sort of slowing down as we moved into the marketing year. But if we project where we're at with commitments and exports out to the end of the marketing year, we get to a number that's pretty close to that USDA forecast. The concern that exists is, well, do all of those committed sales turn into actual exports? And here the picture is a little bit more uncertain. The red line at the bottom here represents actual exports to date. And while 36% of our commitments and actual exports are expected to go to China, only 11% of what's actually been shipped is being moved to China. So there are these big corn sales that are on the books. The question is, how much of that actually turns into actual sales? And there, the pace has been relatively slow to this point. Some of that might be due to supply chain issues, and we had the hurricane situation in the Gulf earlier back in September. But the sort of what's happened in more recent weeks through November isn't particularly encouraging, and I think there's sort of there's some uncertainty here. The other uncertainty is that USDA projected or WASDE forecast export number includes significant exports or imports of corn by China, and there's sort of a lot of uncertainty about whether they get to whether China imports that much corn. The current USDA forecast is based on basically what was last year's actual number of about 26 million metric tons of corn imported by China. There's a question about whether they'll actually import that much. On the soybean side, the current export pace, that is actual exports plus committed sales, looks a lot more like what we've seen in past years, and we've seen particularly strong movement to sort of turn those committed sales into actual exports. So the total sales here, the sales pace to date, is really close to the 5-year average. If you carry that number forward, based on past behavior, we get something really close to the WASDE forecast amount, and we've done relatively well in turning sales commitments to actual exports through October and November. The accumulated exports, the red line here, increasing sharply following early slowness that was mainly a result of supply chain disruptions in the Gulf of Mexico. So I see sort of big picture. It seems like we're sort of well on track to meet the WASDE forecast on the soybean side. On the corn side, I think a little more uncertainty because of this issue of turning committed sales into actual exports, and whether we can get there on the corn side, I think, is an open question. With that, I'm going to turn it over to Scott. Scott's going to take us through the current marketing year balance sheet.
All right, thank you very much, Joe. So putting up some history on the U.S. corn supply and use balance table in this slide. 3 years of history, and then we have the latest USDA November WASDE numbers in the next to the last column, and then Joe and I's forecast for 21-22 in the last column in red. Just a few highlights from our 21-22 forecast to look at differences where we land relative to the USDA. The first is that we're looking for final acreage on corn to be up just a bit, a couple 100,000 acres, a little bit higher yield, and that gives us roughly 60 million bushels of higher production. In terms of the usage side, the big thing to note, we're based on Joe's analysis that he just presented, we're going to lower exports for the current marketing year by 25 million bushels, recognizing the uncertainty about shipments. You put it all together, our ending stocks forecast is at 1580 versus 1493 for the November WASDE. So we're up roughly 90 million bushels compared to the latest WASDE estimates, gives us a 10.7% stocks to use number, which is really, these are pretty small differences. The big difference is there at the bottom line. The latest USDA WASDE season average price forecast is 545, and we're coming in at 485, which is certainly a lot lower, is 60 cents lower. So how do we get there? Well, that's based on some modeling that we've done of the relationship between the ending stocks to use percentage and the corn price in the current ethanol era. This is a chart we showed in our last webinar as well. And we basically have a series of relationships that we think do a pretty good job of at least benchmarking the basic pricing dynamics in the U.S. corn market. First off, you have the magenta line, which is when we get really low stocks, you tend to get really high prices. And that's that really steeply sloped line. And then you have kind of more normal pricing relationships in the green and the red, which we call high demand and low demand models. And you can see the different years that fit on those data points. So if we look at and take literally, if we go with a high demand model, that green line, and we run out 10.7% stocks to use ratio, it says $4.26 per bushel. That can be contrast where the November WASDE is at 10.1% and 545, which is not really on any of the relationships, which of course makes it really interesting. It doesn't mean that the WASDE combination is wrong. It's possible that it's part of the what we would call low stocks environment pricing. It's just a new data point, and it could turn out to be right. So where our 485 comes from is classic split the difference. We just take basically the average of 545 and 426, and at 10.7%, that's how we get 485. So the message from this analysis is that, of course, we already have several months of the current marketing year at high prices. So to get to 485, there would have to be a pretty good dip in the price of corn, particularly in the second half of the marketing year. So that's what's built into our price assumption on corn. Take a quick look at soybeans. Same setup in terms of the 21-22 balance sheet. This is again for the U.S. only. And just the differences versus USDA, we expect in that final survey to find a little bit higher yield on soybeans, no change in the acreage, and then the usage numbers being basically the same. We don't see anything that would lead us to disagree right now with the WASDE estimates in November. The increase in production gives us just slightly higher ending stocks projection of 365 million bushels versus 340, slightly higher stocks to use ratio, and the same price. So that's where we come out on old crop. Now we want to switch gears and start talking about acreage in the US for 2022. And let me start by prefacing my remarks in this section of our presentation. I regard this as a pure data exercise and realize in the marketplace, just say it up front, Joe, the numbers are probably going to be really surprising to a lot of people, but it's important to recognize, basically, we're just trying to do a pretty straightforward data exercise and see where it leads us. And I think it'll probably certainly cause some discussion. So this is the place that I certainly like to start off in thinking about planted acreage, is not starting with any individual crop, but starting with the total planted crop acreage each year. This goes back to 2006. My good friend Darrell Good always liked to call this the size of the acreage pie. And you might think that that's really doesn't change much. And in percentage terms, it doesn't. But you can see that there is, in fact, quite a bit of variation over in time in what we call the total acreage pie. And here, note that I'm dividing that into two parts. The green part of the bar represents principal crops. Those are the 20 to 22 major crops in the United States, of which the big three are corn, soybeans, and wheat, typically around 70% of the green bar levels for total acreage are in corn, soybeans, and all wheat. The red is prevented plant, which we know particularly from 2019 and 2020 have been really huge in some particular years. But this is the starting base. And so I like to think of this as if we add the prevented plant and principal crop, that gets us total intended planted acreage by U.S. farmers in each of these years. So that's all I'm doing here is now just having one color bar for the total. And what I want to highlight are two things here. First, the decline in total planted or intended total planted crop acreage in the U.S. from 2013's peak of 332 million acres to the low in 2021 of 319.3 acres. That's a drop of 12.7 million acres, which in and of itself is an interesting question, is where did all those acres go, Joe? But we really don't have time to delve into that. If somebody wants to ask a question, we can certainly discuss some hypotheses that we've developed. But with the recovery in prices in late 2020 and particularly into the spring of 2021, most analysts were expecting in 2021 that this total would recover. And you saw that in particular in market analyst expectations before the March prospective plantings report, and even for the June USDA acreage report, did not materialize. In fact, we were down 1 million acres in 2021. Why that was happened, there's various possible explanations, but it's probably best explained using this chart. Here, what I'm showing is the same total acreage intended each year from 06 to 21, and a measure of the economic incentives to expand and contract planted acreage. And my measure is a really simple one. I'm just looking at the price of corn, the US average for the previous marketing year. So this is a 1-year lagged corn price versus that intended crop acreage. And you can see it's certainly not a perfect relationship, but the size of the acreage pie does expand and contract consistent with economic incentives, here indicated simply by the price of corn. And you can see why, analysts that looked at it this way, like I did in the spring of 2021, expected a rebound in the total acreage that was under cultivation for planting last year. But the fact that it didn't go up is not completely surprising, because this is an imprecise relationship and it doesn't fit perfectly. You can see that corn prices were going up rapidly in 11 and 12, and it really took until 2013 to register the full impact in total acreage. And you see the same thing as prices were going down. The lags are uncertain. But what we can say for sure is that prices are going up, so therefore we should expect the size of total intended acreage in 2022 to go up. How much? Well, this is one projection. So notice here I'm using the 545 as the lagged price for the 2022 acreage. If I used our 485, I might get a little bit lower acreage. But if we just take that jump in lagged prices literally, we will project total acreage to go up 7.2 million acres, a big jump. Obviously, it's early. There's a lot of uncertainty. Plans can change. We're still technically finishing up fall tillage, fertilizer application, a lot of dynamics at play. But that's taking the simple relationship. Someplace around 325 million acres seems like a good total acreage projection right now. That's critical in then moving towards the outlook for corn and soybean acreage. What do you think is happening to the total? Because the economic incentives for competing crops, in particular wheat and cotton, are quite good this year. So if you, for example, assume a roughly constant total, then you wouldn't have room for all crops to basically expand their acreage. So that's going to be an important foundation of where we're headed with the rest of for the corn and soybean acreage projections. Basically, I'd summarize this part of the analysis as saying enough acreage for everyone, Joe.
We see that down. Absolutely.
Okay, so now I want to turn to the subject of our webinar, which is corn and soybeans, and our projections for corn and soybeans planted acreage for 2022. And let me walk through how we get to those projections. We start with total intended corn and soybean acreage combined. That's the yellow top line row of numbers. That's actual planted plus prevented planted acreage. And what you see there is that total just doesn't vary a lot, which is not terribly surprising when that we have a dominant 50-50 corn soybean rotation in the US. And in particular, I want you to look at 19, 20, and 21, right there at 181.5, 181.7. So with the high prices, the fact that we've had some time to build up profits, and that projection of an expanding total acreage base, we're going to bump that up to a recent record high of 183 million acres total. So 1.5 million acres total addition to corn and soybean acreage. Subtract a projection of 1.5 million acres for prevent plant, gives us a total planted acreage projection for corn and soybeans of 181.5 million acres. So going to be a little high, but not hugely high. Again, this recognizes the profits are going to get some acreage expansion in other crops too. Okay, so we've got a 183 or 181.5 for our projections for total. So the big question is, how much of that's going to be corn and how much of that is going to be soybeans? And how do we project that split? Well, we need to start by looking at the incentives to plant corn relative to soybeans. And the classic indicator is the soybean corn price ratio. And here I'm showing the daily ratio of the November 2022 soybean futures to the December 2022 corn futures through November 19th of this month. The break-even ratio that we use for a futures-based ratio is 2.3, shown in the red. And of course, it's a really interesting story in the market pricing of corn versus soybeans in terms of planting or acreage incentives. For the last year, this indicator had clearly been signaling a sharp increase in soybean acreage relative to corn. And then we had the very large increases in fertilizer, in particular nitrogen prices, begin to show up early in the fall. And we saw basically corn prices, new crop corn futures prices rally a bit and soybeans fall. The combination caused a dramatic change in the incentives to plant corn versus soybeans, and dropping all the way from a ratio in late September of around 2.5 to recently about 2.25, and as of this morning, all the way down to 2.22, almost down to 2.2. So a dramatic shift in this traditional indicator of corn versus soybean profits. Now, you might ask, well, one response is, well, maybe the 2.3 is not the right break-even ratio because of this dramatic increase in fertilizer costs, in particular nitrogen. Well, we had Gary Schnicke and his co-authors did a great FarmDoc Daily article on November 2nd earlier this month, taking a look at this for Illinois. And as a lot of people are talking, fertilizer costs are projected to go up for 2022 versus 21 by $100 an acre. It's clearly large. But what's, I think, lost in the discussion is that fertilizer costs are also going up about $50 an acre for soybeans. So the net difference in fertilizer cost is not as large as you might realize. It's a net increase for corn of about $50 an acre. And what they showed in that article was that at the same current forward bid structure we're looking at right now, at least in Illinois, corn was more profitable than soybeans by about $30 to $40 an acre. So very consistent with the picture we get from the ratio. All right. So now we can plot that new crop futures ratio. What I found a reasonable relationship with is the percentage of soybean planted acreage out of that total. And just as a reference point in that relationship, at 2.3, the break even, we can tend to not quite get 50% acreage in soybeans, about 46%. What's really interesting, at that 2.25, historically, that's about 44 to 45% acreage in soybeans. That just really seems unrealistically low to me right now, given the discussion about market incentives. And again, the relationship is still has a lot of uncertainty. So I'm going to go with a ratio of 47%, even though that's certainly pretty conservative given the current new crop future soybean corn price ratio to project the acreage. And if I use 47%, here's how I do it. I take 183 times 0.47 gives total intended soybean acres of 86 million acres. 183 minus 86 is 97 million acres. And so I take off 1 million in prevent plant for corn, 500,000 for soybeans, and I get 96 million acres projected planted acreage for corn and 85.5 for soybeans. So I'll allow people to take a little bit of a breath and absorb those numbers. That's what this pure data exercise indicates. And I recognize that that is far from where most people in the market are talking about for corn and soybean planted acreage, particularly for corn. One prominent estimate that was recently released was under 91 million acres planted for corn. That's after prevent plant, I presume. So the data leads us to look for a heavy increase in corn acreage, although going from 93.3 to 96, that's 2.7 million acres. That's not a gigantic increase, but it's just very different than what the market seems to be expecting based in particular on the run-up in nitrogen fertilizer prices. So that's where we come out on acreage. Now I'm going to translate that into a quick first look in terms of the balance sheet for 22-23. Got the 96 million planted, 88.7 harvested. I use 179.5 for the trend yield forecast. Basically, I lag the USDA estimates by a year. I'm comfortable with that. Gives us almost a 16 billion bushel projection for the corn production. I take feed and residual based on the larger crop up 50 million. A little more ethanol usage, 50 million. And I drop exports by 100 million, expecting greater competition globally, and put that all together. And I get ending stocks of 2610 versus 1493 is the latest November WASDE, and a stocks to use ratio of 17.6%. At that heavy of a stock level, I get a season average price forecast of 425. And at that kind of stocks to use, that's probably, Joe, a little bit even optimistic. And Joe's going to get more into this in just a minute. Notice that today in East Central Illinois, new crop out of the field bids for corn are at $5.25, $1 higher. Just go through the soybeans. I use 51 bushel yield for soybeans and just minor changes in use numbers. And interesting, again, mainly a function of a decline in soybean acreage. We actually have ending stocks for soybeans dropping in 22-23 to 292. That's 6.6% stocks to use ratio, but with a projection of overall global tightness easing on soybeans, we're looking at a and a price of $11 a bushel, again, $1 below current fall bids for next year. So with all that, Joe, he's going to talk a little bit about pre-harvest marketing.
Yeah, I think, Scott, maybe the takeaway from what you've discussed here is in some sense, it seems like the market is trying to buy a lot of acres, particularly on the corn side, with current prices. The current new crop December futures price somewhere around $5.60 a bushel. New crop soybeans for 2022, the futures price around $12.40 a bushel. And those new crop bids, while the basis levels for those new crop bids aren't especially strong, seems to be still relatively high corn prices relative to what you would get if you think that acreage is going to respond in some way, that the profitability of new crop corn production looks still pretty good. We want to think about, well, what does this mean? Should you be selling a lot of new crop corn, given where new crop bids are relative to the forecast that Scott presented? We certainly don't know what prices will be when we get to the fall of 2022. So what I'm going to do is look at some tendencies in historical pre-harvest marketing period prices. So the prices for that new crop futures contract between, say, now, about a year from harvest, and the eventual harvest time price. To sort of answer this question, does pre-harvest marketing pay over the long run? And in particular, what does it look like in years like this one, where it looks like new crop bids are relatively strong? So I'm going to put up two graphs that look something like this. Lots of colors, but basically sort of trying to summarize what is the behavior of that new crop corn futures price relative to the price that we end up getting at harvest. So to make this comparable, we're going to present this just in terms of how high was the price in any week of this pre-harvest marketing period relative to the price that eventually prevailed at harvest time, in particular for corn, when the new crop future, the December futures contract, reached the first week of December. So in this graph, the green bars are periods where that new crop futures price was well above the price that ended up prevailing at harvest. The magenta bars are periods where it was far below. And I think the takeaway from this graph is, though the last 2 years, the top two lines of this graph, 2021 and 2020, suggest it had pre-harvest new crop prices that were below the price that ended up prevailing at harvest. There's a lot of green on this graph, and so relative to, again, to that benchmark, price that prevailed when we were at harvest, the price that you could sell at, sort of across the scale, prices for corn tended to be higher. Now, there are some years where this is especially so. You think about years like 2013 and 2008, where we had prices well above the price that ended up prevailing at harvest. And those are sort of years that followed the boom. In those years, we had prices well above. But even if you sort of take out those years, there's still a lot of green on this graph. And pre-harvest marketing tended to pay for corn, at least over the last 20 years. I'm going to present a very similar graph for soybeans. And again, I think, so we're looking at how did the November futures contract behave over that period from about now, the sort of the post-harvest period, sort of the once we sort of reach post-harvest for the previous marketing year, all the way till that next harvest. How did that November new crop futures contract price behave? We see some periods where sort of pre-harvest marketing was profitable relative to selling across the scale at harvest, but a lot less green on this graph. A lot fewer periods where the new crop futures price was well above the price that ended up prevailing at harvest. With some exceptions, again, 2008 was a year where coming out of the boom, prices crashed pretty hard, and new crop pre-harvest sales paid paid off significantly. But on average, so what we want to do then is sort of take this sort of historical experience and look at, on average, given that we don't know what price will prevail at harvest. We've had some years where we thought we had, relatively good prices, especially sort of in this year, 2021. We look at, there were some periods back in June and July where there were good opportunities to sell soybeans before harvest, relative to what you would have got selling across the scale. But then, given that we sort of don't know what prices will be in 2022, what is sort of the long run performance of pre-harvest marketing for corn and soybeans relative to selling across the scale at harvest? So what I do is take this historical experience and average it across all years. So the dark blue line in this graph represents how you would do the price that you would get relative to the price that ended up prevailing at harvest if you sold in a particular week of that pre-harvest marketing period. And for corn, though the range of outcomes is wide, for corn on average we see a pre-harvest marketing premium of somewhere between 10 and 15% for the period between now and about midsummer. Once we get to the middle of summer, that the crop size sort of seems to be relatively clear, and we get much closer to the price that ends up prevailing at harvest. This premium sort of tends to dissipate as we get through July, August, and September. But on average, again, selling new crop corn futures tends to be more profitable than selling across the scale, at least in terms of the futures component of the price that's received. Again, the one thing just to note is the range of outcomes is wide. That maximum there represents what you would have got if you had sold in 2008 relative to the price that ended up prevailing at harvest that year. However, even if you take that big year out, you still get this pre-harvest marketing premium for corn. The average level doesn't change much, even if you take out that maximum year. For soybeans, the story is considerably different. The average price right a year from harvest is actually slightly below the price that ends up prevailing. But again, the range of outcomes is wide. You might be 25% above, 25 to 30% above, or 25 to 30% below the eventual outcome. That prevails when we get to harvest. If you want more information about this, I have a FarmDoc Daily article that I published back in mid-June that kind of walks through in greater detail this exercise of evaluating pre-harvest marketing performance based on changes in the new crop futures price. The one thing, the caveat that I haven't sort of written down here in the slides is to think about, is to make really clear that the benchmark in these graphs, so when we look at what was the price relative to the price that ended up prevailing at harvest, the benchmark here is, again, that harvest time price, not the price that we see for old crop and not the market structure that prevails right now. So if we think about the current market structure, we've got old crop futures prices that are higher than the new crop ones. So you might think, well, is the fact that we're in an inverted market, the market is saying, the price is going to be lower next harvest, is that an indicator to sell now? And that's not really the case. So we've had years where we had, pretty significant inversions, that is old crop prices being higher than new crop prices. And in those years, it's not consistent that we see this pre-harvest marketing premium appear. So 2008 was actually one of those years where for corn, the market was not inverted a year out. The new crop price for 2008 relative to 2007 looked to be better, and it ended up being the case that you would have done significantly better in 2008 selling sometime between March and August. So given that, again, the idea is pre-harvest marketing can pay, but it's something that pays on average over the long run. It's not something that you can sort of try and time the market and find these years where there's a big incentive to market ahead of harvest. The market seems to do a pretty good job of sending the right signals about how much to plant, how much to sell going forward. So with that, we'll conclude.
And we'll take some questions in just a bit. In fact, I think Joe and Scott, I'll give you a moment to look through those questions. There are a number of them, and we will get to them. I do want to remind folks that the Illinois Farm Economics Summit is sponsored in part by TIAA, that's the Center for Farmland Research, Compeer Financial, Corteva Agri-Sciences, Farm Credit Illinois, Illinois Soybean Association, Growmark, and the Illinois Corn Growers Association. We thank them for being a sponsor of our programs so very much. And we'd also like to thank our educational partners. They include Illinois Extension, FBFM, that's the Farm Business, Farm Management folks, and of course, the Department of Agricultural and Consumer Economics here on the University of Illinois campus. Again, a reminder that if you're joined us today, you're already signed up for the rest of the virtual Illinois Farm Economics Summit. On Wednesday of this week, we'll take a look at farm income with Gary Schnitke and Dale Latz and Krista Swanson. And then Friday, supply chain bottlenecks and some management decisions. Gary Schnitke will be back along with Nick Paulson. Next week, Bruce Sherrick will be in on Monday. That's December the 6th to talk about farmland values and rental rates. And we'll wrap up with a policy update. You won't want to miss that one. That's on Friday, December the 10th. We do appreciate again that you are with us. If you'd like to see these programs, they go up online usually really pretty quickly after we finish up. So be checking this site. You can see down there where it says YouTube. If you go to youtube.com, this is the easiest way to find these videos, youtube.com/farmdoc video. There will be a whole bunch of them there, but also including this Illinois Farm Economics Summit. So check that out. Otherwise, you can always go to farmdocdaily.illinois.edu. Might be easier for you to remember. And then look in the archive section under IFES, Illinois Farm Economics Summits and Webinars. So that's a quick way to take a look at that. I bet Joe and Scott have gone through some of these. Do you have one that you would like to start with today? And I don't know, Scott, maybe you'll take a shot at it?
Yeah, why don't we handle, there was several questions about input and fertilizer prices and acreage.
Mm-hmm. That's certainly been a story that the market has tried to digest over the last month or so.
It's been a dramatic story because we're talking about, nitrogen prices, I believe are up more than 100%. So we're talking huge increases in input costs. So, but basically, that's only one half of the equation. The other half is what's happened to output prices, the price of corn and soybeans. So when you look at the enterprise budgets, again, the projections, the latest that we have here at the U of I is in total fertilizer input costs for corn for 2022, based on the latest very high prices, imply $100 per acre increase in cost for corn. So it is a large increase. But soybean costs are also going up. Latest projections, $50 an acre. So the net difference, well, again, it's not trivial, but it's only $50 an acre. And so that can be offset fairly easily by swings in corn versus soybean prices. And that's what we've seen. At least here for the heart of the Corn Belt, the economic incentives right now clearly are signaling plant more corn. On a budgeting basis, Gary Schnitke and his co-authors are projecting in all areas of Illinois right now that corn will be more profitable than soybeans by $30 to $40 an acre, which is a real switch from what it was previous to the run up in fertilizer prices last summer. My own personal take, a little editorializing. You can disavow this if you want, Joe.
I might.
You might. It looks to me like the market might have just slightly overreacted to the run up in fertilizer prices, assuming that was going to clearly there's a relationship between the incentives to plant corn, but it seems like we might be overdoing it a little bit relative to buying corn acres.
I think that's fair. You look at where the maintained strength in corn prices, and it doesn't seem that the market is saying, oh, we expect a massive amount of corn acres and a big corn crop going into 2022.
Yeah, I mean, you're looking at, any pre-harvest price of $5 is a high price for out of the field for corn, even with these input price levels. And again, I recognize that this can change. Mm-hmm. You go out, particularly in the Great Plains, the economics are not the same. But overall, that's the picture that I see as of today is despite the dramatic increase in fertilizer prices, I still think we're going to see a big increase in overall total planted acreage and heavy corn.
I have a follow-up on that based on a question that somebody asked, which is, do you think there will be adequate supplies of fertilizers to produce the corn and soybean acres you're suggesting?
That's an excellent question. I mean, this can be thrown into dramatic disarray, this outlook. For example, we don't want to think about it. I'm certainly have no expertise to forecast this, but from what we've been through in the last 18 months or 2 years, 18 months, what if the latest variant is something that, is dramatically more virulent than what we've experienced so far? Let's certainly hope that that's not true. But, that's kind of like another black swan type event that could come at us and could make these supply bottlenecks continue well into 2022. My own personal view is that I still think that that's unlikely. I think that we'll see these supply bottlenecks ease by the time we get to spring, but there certainly are huge risks that could be wrong.
I think that's right. The thing that I guess I'd add is the question is not just sort of, will there be fertilizer supply chain bottlenecks, but how do those supply chain bottlenecks affect farmer decision-making with respect to planting acres and producing a crop in 2022? I don't know if it means that, I don't think it means we don't have fertilizer so we idle acres or we dramatically reduce the market is still telling the US farmer to produce corn and soybeans. These are historically relatively high price levels. And so there will be an effort made to produce corn and soybeans in 2022, a strong effort made to do that.
Have you thought very much about how that impacts the corn crop, safrinha crop out of South America, Brazil in particular, and whether they have available supply of fertilizers to put down crops?
What's interesting there is the supply chain risks are greater for Brazil because it's now that it would be potentially availability could affect their decision making. But I'm going to be on the side that the economic incentives are so large that I think they're going to go through with their expansion. I guess we're in for a speed round. Our director is signaling us.
I think we probably should talk about soybean demand a little bit. We've seen pretty strong crush margins, pretty strong incentive to crush beans domestically. But Scott, what do you think about sort of given if we see not a huge jump in soybean acres, that what does that mean for the demand picture for soybeans?
Great. I could talk a whole hour on this. In fact, I'm doing another webinar tomorrow that is exactly on that topic. And in short, if there's a bullish surprise coming in the corn and soybean markets in 2022, I think it's going to be on soybeans, not corn, particularly on use. If you study what's going on with renewable diesel, boy, with plants that have already come online and the new ones that look like they're definitely coming online in 2022, we're going to really stretch the availability of vegetable oil supplies in the U.S. and even globally. So it's a big potential market issue. We've already seen this show up in changing the historical relationship between soybean and soybean meal crush values. I think it's a great question. Nobody really has, I think, a great answer to it, but it's definitely something that if there is a surprise, it'll be coming through that soybean oil demand for renewable diesel.
How much of that is a sort of 2 to 5 year phenomenon versus a 1 year phenomenon?
Well, a lot of that depends on whether all the plants that are in the planning stage get built. So the two big issues are how long does the renewable diesel boom last? It's kind of almost literally crazy numbers through 2024 right now, but will they all get built? And then the second one that doesn't get discussed much, that's a very important part of the equation, is how much of what I call FAME biodiesel, traditional biodiesel demand, does new renewable diesel plants cannibalize? And so you have to try to project both variables.
Have you guys taken a look through the rest of them in the speed round, or do you want me to pull one out?
You just go ahead. You do it. You'll be much more efficient. Go ahead, Todd. You've got the helm. Speed round.
Okay. So speed round, China stocks as a percentage seem to be high at this point for corn. Have you given some thought to that? And what confidence levels do you have in those numbers?
So I don't have any confidence in those numbers. So I'll take that part first. It seems like, I think if you look at the USDA numbers, they're not sort of, they're taking a lot of the increase in Chinese corn production this year and moving that into stocks. So I would assume some of that might be more like usage, which kind of justifies sort of the current market situation, the relative tightness in the corn market. But I don't have a lot of faith in those numbers, so I won't go out too far on that limb.
All right, we're up next.
Scott, would you repeat why you see soybean prices declining in 22, 23, despite the smaller crop and tighter stocks?
Just mainly it's a function of the lower overall movement in grain prices led by corn and a very large South American soybean crop. I mean, the USDA is at 144 million metric tons right now. Weather continues being reasonably good. Without a big La Nina, they'll go above that. So that's the reason.
Somebody asked this question. We talked about it before we opened up. Will farmers lower their fertilizer rates, and will that have an impact on yields?
I think yes, they will. I mean, when prices go up, people economize, and farmers are no exception. So I think fertilizer rates may drop. Whether they'll drop in a way that drop enough that significantly impacts yield, production, and prices, I think there's less indication that that's the case.
Are carbon credits going to be relevant as farm income in the future, do you think? Different topic, of course.
Yeah, possibly, but I think we have a long ways to go for the market structure to be formalized and the science about that becomes built into a market structure becomes standardized and accepted. There's a lot of work going on this, but my perception is we're a ways away. I don't know if
I think that's exactly right. There's a lot that needs to happen before there is, I think, a functioning carbon market where there's a good understanding of what's being bought and sold and the economic value of it.
I did see one question, Todd, I wanted to answer. Someone asked about the historical performance of the corn model that I presented.
Correct.
It's always good to have a new model. So it's new. I actually just developed that formally this fall. So what you see is the historical fit, and as always, we'll know a lot more in a year, won't we, Todd?
We will know a lot more in a year. I think in that same question or related, somebody wanted to know about the 426 you had as the low on that model, and then the 425 or whatever it is, or 525, I think that USDA currently has. Did you just split the difference to get to 485, and why did you split it? And
Yes.
Is it about what's already been sold too?
No, it's just simply, it's without getting deep into the statistics, when you have huge amounts of uncertainty and you have competing forecasts, taking an average of them, the research suggests that that's your best forecast.
Although I think there is a part of that season average price is a function of pricing throughout the year, and so I think that yes,
that's why
part of it has to be that the current crop has been sold already to some degree at prices well above $5.
Yeah, so the 426 is what is represented today.
Right,
but for the market
without anything
level that justifies 545 as the season average price for 2021-22 is, I think, where we see where we're somewhat skeptical.
Yeah. All right. I think we'll wrap it up there. Thank you both. I appreciate it. Scott Irwin and Joe Jansen are agricultural economists here on the Urbana-Champaign campus of the University of Illinois. Join us for this first in the 2021 virtual Illinois Farm Economics Summits. We'll see you back here on Wednesday. Our thanks to Jim Baltz, who's been behind the scenes making everything go really well for the day. Thank you, Jim. And I look forward to having you for the rest of our programs Wednesday and Friday this week, and only Monday and Friday of next week. I'm University of Illinois Extension farm broadcaster Todd Gleason. You have a good day.